India's market regulator is barring Jane Street from access to its local securities market. SEBI also plans to seize $570 million of what it calls unlawful gains from the U.S. trading firm after an investigation into derivatives trades that generated billions of dollars. Jane Street, in a statement, says they're disputing these findings. Let's get the details with senior reporter Abhishek Vishnoi. Abhishek, it's really about SEBI clamping down, having greater scrutiny over these foreign institutional investors.
That's right, and this may possibly be the biggest, fine that SEBI has employed on a foreign entity like Jane Street. It may actually be the biggest fine if it materializes ever, for such kind of market manipulation, alleged market manipulation. Now, the ramifications are strong, especially for the derivatives market. I mean, if you look at India's derivatives to cash volume, it's more than 400 times. That kind of figure does not exist in the US, Germany, and many other developed markets. So implications for derivatives market would be big, but for the cash equity, the bread and butter, the main India story would be low. There would also be implications for exchanges. Obviously, they are the first ever regulator and the marketplaces. So there might be some impact on BSE. NSE's IPO is on the anvil, so who knows? Maybe the valuation may get impacted there. From what our reporting or our conversations with the market participants suggesting, this can be looked at, on both sides. Like, it looks like a move done by EM, but it's also something similar to what SEC does in the US. And, US makes 60% of global portfolios. India is not even 10%. Jane Street was making $2.3 billion, and that was more than 10% of their bottom line. So there is a context to this, and it shows how big market inefficiency exists in India, and how such low guardrails are there in India that regulators is now trying to close. So it's going to send some chills down HFTs, algo traders, and proprietary traders.